said free beers.
All right. Folks, are you guys feeling ready to go? Yeah? Paul, you guys all over there? You guys good to go? Okay. Super. I think we can get started. So thanks everybody for joining. My name is Gaurav. I'll be moderating this session on leveraging catalytic capital, the role of philanthropy in innovative finance. Now, who doesn't really want to be catalytic, right? So if we talk about catalytic capital in the, or catalytic philanthropy in the biggest sense, all of us think that when we're engaging in this, we're trying to be catalytic. So this is really looking at a subset of that question around the role of actually blending money with other money to see how we can catalyze this. And we've got a fantastic panel who's going to talk us through when to do this, when not to do this, examples of things working, some of the pitfalls, and we'll, at the end of this session, I'm going to ask the audience how convinced they are of the role of using philanthropic money in this form of blended finance. So we're going to also make this interactive. But to get us started, let's just understand who's on the panel. And I'm not going to introduce each of them. We all have LinkedIn. You can see everyone's bios. Instead, I'm going to start with a question for each of them. What is bringing you to this specific conversation on philanthropic catalytic capital? Tell us a little bit about where you're coming from in this conversation, and then we'll get started with the question. So Harvey, maybe I'll kick it off with you.
Is this on? Great. Thanks, Gaurav. So our interest really started, I would say, over 10 years ago. So we had a team in India trying to build new inclusive enterprise impact models, and realizing that actually much of the capital that was needed by these enterprises and these models actually wasn't being supplied by the sector. And so did a lot of work on something called the Pioneer Gap about 10 years ago, saying actually we needed more flexible capital to come in, particularly at the early stage of the development of these models before things were proven, right, to really underwrite their early development and prove them out so actually more mainstream capital could come in. So it's been a long-standing interest. It wasn't called catalytic capital then, but it's great to see more discussion going on around that. And so working now much more with, for me, on the investor side to mobilize that.
So I work for an organization called Convergence, and we are a network builder for blended finance. By definition, blended finance is all about catalytic capital. And so we work with a whole range of different stakeholders, philanthropy being one of them, and using concessional money from foundations, from high net worth individuals to really mobilize or catalyze private investments. And so everything that we do, everything that we think about is all about catalytic capital.
Yuko?
Hi everyone, my name is Yuko. I'm from an organization called Japan Social Innovation and Investment Foundation, SIF for short. We are a spin-off of a foundation called Nippon Foundation, which is the biggest foundation in Japan. Our mission is to promote impactful capital, such as impact investing and impactful donation in order to solve social issues in Japan. We have two main pillars. One is we actually create an impact investing model together with third parties, such as financial institutions and government, in order to demonstrate that impact investing actually works. One example of this is that we co-GP a venture capital fund together with the Japanese financial institutions. It's called a Hataraku Fund. Hataraku means to work in Japanese. So we invest in social enterprises that has the potential to change the way people work in Japan. And our other pillar is more research and advocacy. We do a lot of research on impact investing, and we also work with governments to host conferences on impactful capital. That's about it.
Thanks very much. I'm Paul. I'm from the Stone Family Foundation. We're a UK-based charitable foundation that also acts as an impact investor in the region. We're very focused on water and sanitation and the role that the private sector can play in delivering better services. And I think the sector is chronically underfunded, and across the whole spectrum of capital. And I think we see our role as taking risk and trying to draw other types of capital into the sector and try to be a proof point and demonstrate that impact investors in the region can have a lot of success in investing in water businesses in Asia. So that's what brings us here today.
Great. Welcome, everyone. And I'll also answer the question for myself. So, hi, everybody. I'm Gaurav. I'm a partner with Dalberg. A lot of our work, we end up building instruments that are effectively enabling catalytic capital, development impact bonds, blended finance instruments. We helped with setting convergence up and so forth. And the other side of my work is actually advising a lot of philanthropies on where to lay their capital. And I guess, just to kick us off, I'm going to act as a fairly skeptical moderator, because it's a pretty high bar for me to ever tell a client in the philanthropy space to blend their capital with private finance. And I think that's, so I'm going to bring a little bit of that to this conversation. But maybe to get to laying the tracks here and just understanding the space, the overall sort of shape and definition of it. Harvey, you've been working with C3. They've been doing a lot of foundational thinking on this space. Help us define it.
Sure. So C3, if you've not come across this, is the Catalytic Capital Consortium. So it's the MacArthur, Rockefeller Foundations, and Omidyar Network who've got together to say, they've obviously done a lot of catalytic capital investing. They're trying to build a field now of catalytic capital. So they've done investments through C3, and also they're doing field building, and they have an active grant-making side to that. They're doing knowledge research networks. So AVPN, I think, is one of the most recent partners in Asia for the C3 initiative. So C3 some years ago commissioned some work from Tideline that said, actually let's start to describe at least the landscape of what we mean by catalytic capital, right? So the three areas that emerged from that work, three roles, if you like, of catalytic capital were described as the seeding, scaling, and sustaining roles of catalytic capital. And broadly, catalytic capital is defined as capital that essentially will accept disproportionate risk. It's flexible capital that accepts disproportionate risk or concessional pricing in order to go where other capital will not go. Now, there could be other kinds of flexibility, but let's just start with those. So if you think about the three roles, and I'll give you some examples, they're quite different, right? So, and seeding and scaling sort of refer to that pioneer gap problem that I was referring to before. How do you get something from, nascency to commercial maturity and mainstream acceptance? So in the seeding role, things are new. They're very novel, right? So if you think about in the sort of Southeast Asia context, things like Beacon Fund, which is a new fund looking at women-led moderate growth SMEs, or SWEEF, Southeast Asia Women's Economic Empowerment Fund. These are new funds, new-ish managers, often novel investment themes, sometimes new investment structures, often not very big, so they might be targeting, $50 million with a first close at 15 or 20 million. So not huge funds, right? So there are lots of barriers for institutional investors trying to commit money to these funds, right? You've got to underwrite a new manager, right, without an organizational track record. It's sort of small ticket size, all these things are kind of issues. So, and I think what's worth saying is that none of these managers set out to say, we want to only get catalytic capital, right? Catalytic capital is needed because they can't attract mainstream capital, because mainstream investors aren't willing to go in, right? And so catalytic investors are the ones who are often the first in, right, to anchor those funds and get them started. So that's one area. That's kind of maybe the most obvious one, right? The second one is scaling, right? So that's where you might be onto your second fund, your third fund on a theme. You may be a more established manager, but you're still lacking the proof points to really get commercial acceptance. So it might still be blended, for instance, right? So something like Responsibility's ACPF, Access to Clean Power Fund, which is their second fund on this theme, much bigger numbers. So targeting like 200 million, right? Their first close at 151 million, so much bigger numbers. Much bigger emphasis on mobilizing commercial money into these funds, because you need that to get to scale. But it's still not at the full level of mainstream acceptance. So there's still a role for catalytic capital. I'm sure Archives can speak especially to that role, which is huge because blended finance plays a huge role in sort of those transactions. And then finally, the sustaining role, which I think some people don't think of as catalytic capital sometimes, but C3 does, which is what if you need long-term capital that's subsidized or highly risk absorbing, right? So another example, also active in Indonesia, is someone like Root Capital, who work in Indonesia in the more remote part, but also, Congo and Haiti, right? If they were to charge the full risk premium of lending to small agri-businesses in remote areas to those businesses, it would be completely unaffordable for those businesses. So the funding that they require needs to be more concessionally priced in order to make the model work sustainably and with impact that's intended. So that's a completely different category from the first two in that it's more of a long-term structural need.
And I want to come back to that last one because, I mean, the first two are very clear. The third one sort of raises my questions. But Akif, we got a sense of definition, but you at Convergence actually see transactions happen. You've helped broker things. So dimensionalize this. Like, how big is this? Is it growing?
Well, Gaurav, I'm glad you asked me that question because I've got some data with me. And that's what we do at Convergence. One of the things that we try to do is we try to put some numbers around this market, what it looks like, and what are the trends that we're seeing. So if you look at philanthropic advisors and investors using blended finance strategies, they've mobilized around $19 billion of private capital or additional private capital towards the SDGs from a total quantum of around $160 billion. Philanthropic investors are also are active in 1/3 of all the blended finance transactions that we've tracked. And we've tracked around 800 plus to date. And when we look at all the various investors that are part of these blended finance transactions, we have around 1,200 odd investors that we've tracked. Philanthropic investors represent around 10% of this number. However, they represent about 25% of all concessional financing in these transactions. So this really goes to show that they're quite muscular in terms of their leveraging and catalytic effect. And that's really what we want to impress upon all of you here today.
Well, we'll come back to this question because I think there's a question of saying, well, they are muscular, which is separate from the question of should they be, right? Are they filling a gap that they should not be in, and are they filling a gap for somebody else? But I wanted to ask you about how much of that is the mainstream giving that philanthropies are doing versus are you seeing some endowments also entering in that space?
Well, most of it is from the program budgets of these large foundations and philanthropic investors. We have seen a shift in the discourse from using program budgets to actually investing their endowment with intentionality and impact. A good example of that is what we've seen with the Sasakawa Peace Foundation, when they're supporting the Japan ASEAN Women's Empowerment Fund that's coming out of their endowment. While they're not perhaps taking a more risk-adjusted position to catalyze and leverage other investors, they still have a demonstration effect towards their own endowment and their own foundation in terms of what can and cannot be done. And that's what we need to see more of. There's a whole lot of funds sitting in these endowments that are being invested in US Treasury bonds or in public equities. Wouldn't it be great if we can mobilize at least a little bit of that portion towards investing with impact?
Well, you mentioned the Sasakawa Peace Foundation. So Yuko, maybe I'll ask this question of you. I understand, I mean, Japan is a very unique philanthropy market. And I understand there's some interesting things going on around mobilizing endowments. So one question is, if you could speak a little bit more of that, because obviously when endowments come into the picture, you're certainly talking about a massive amount of capital. And then also just reflecting on what's been said so far, are you seeing the similar trends in Japan as well?
Yeah, just to give the audience a little bit of background, it might be same internationally, but in Japan, a lot of foundations, endowments are invested in bonds, like national bonds, and it is typically not usual for foundation to invest in something else. But there is recently an interesting trend. Our new prime minister, he initiated this policy called New Capitalism Policy. And in that policy, they have a lot of things, but basically this policy is to promote more human capital and also greater support for innovation and startups. And as part of it, some group of people are starting to advocate so that foundation could invest their endowments in other products such as equity or impact investing. But this movement still just started, so let's see. I'm really excited how this movement will go.
So this is a pretty good macro picture. So Paul, as someone who has experimented with these different instruments, can you bring us right down to a specific transaction you're involved with, and help us understand the role that philanthropic capital played in catalyzing mainstream capital?
Yeah, sure. Probably less mainstream, but we established a development impact bond in Cambodia, focused on the rural sanitation market, which is a $10 million bond. It's the first in the water and sanitation sector. And I guess what we were trying to demonstrate is if you can align through partnership with a group of different actors, you can deploy capital in a very impactful way. And I think the critical thing is to really be clear on why are you doing it? Why are you even thinking about catalytic capital, more complex structures? All of the challenges that brings and shifting relationships, why are you doing that? And if you can be very clear, like you're all aligned on this social outcome, then it's, very, very, can be very impactful. So what we did is, we've been supporting IDE, a US-based organization, have been rolling out rural sanitation marketing programs for the best part of 10 years. They'd supported the delivery of, I think, 300,000 latrines to rural Cambodians. But they faced this programmatic challenge of every sort of marketing sweep they did into villages, they weren't then getting to the poorest of the poor. And we also weren't seeing the public health gains of community-level sanitation. So they needed to pivot their program away from the principles that they had originally. And so we thought, well, could a payment by results structure enable them to do that, to take the risk, to innovate, and to focus on an outcome, which is essentially open defecation-free status, which is a kind of government-led metric. And we sort of questioned and said, well, does a payment by results program make sense? And if so, would a DIB actually make sense? Because a DIB is just one type of payment by results. And then we sort of reflected, well, we did some analysis and did some feasibility, and we worked out, well, yeah, it could, and we believe in that sort of outcome of public health gains at the community level. And then we used that to sort of bring USAID into the sector. They had been more broadly in health, but they had a $10 million allocation for a water and sanitation program that they couldn't find an opportunity to deliver through. And so we then, brokered the DIB, and we've launched it, and it's going really well.
So in that example, you're saying that because of your forward-leaning status in developing the DIB and making that investment, you're unlocking USAID to be more forward-leaning.
Yeah. Ultimately, we are the investor. We've taken all the financial risk. We've shared a little bit of that risk with IDE, but they've taken all the implementation risk as they normally would. And then USAID have come in as the outcome payer. And essentially what we've provided IDE is a line of working capital to deliver their program. They achieve the milestones, we claim from USAID, and then we get prepaid. And what we're doing is recycling capital through the DIB year on year. So actually, to deliver a $10 million DIB, we've only actually had to allocate $2.5 million. So,
okay, that's interesting. Yeah, but are you also going beyond the transaction? What's the long-term impact? I mean, is USAID now saying, because you did this, I'm actually just going to take more risk, full stop? Or were they only able to do it when that instrument existed?
I think more broadly, USAID are very keen on development impact bonds, and I think they're starting to see traction in other geographies. I mean, I think the ultimate goal of development impact bonds is that the government is the outcome payer, and I think that's the next step really. And although the government isn't an outcome payer in this context, it's aligned with the national government's policy around sanitation. It's using all of the mechanisms. And the government is kind of involved, but they're not the outcome payer. But I think that's got to be the next step in these types of instruments. We have to bring the government in as the outcome payer, or at least contributing to that, because then I think you are bringing particularly in sanitation, budgetary allocations in sanitation are, national budget allocations are tiny relative to the problem. And I think that's what we've got to try and do, is demonstrate vehicles through which governments and others can come in and participate, because the social impact of it is enormous.
I mean, I have to say, I love the fact that you chose one of the hardest things to fund, using one of the hardest instruments to fund, and have made it a success. So that's amazing. Actually, maybe for the audience, as a sort of a quick thing, Paul got to dive into that example, but maybe just from all three of you, if you could just share one quick example of a sort of philanthropic catalytic opportunity that you have seen, just to give a sense of the wide variety in which how these things have been done. So maybe just a quick example from each of the other panelists.
God, so many. So I think it's almost like, where is it not, applicable? So, and I think it's always useful to see catalytic capital vis-a-vis what mainstream capital is doing, right? So mainstream impact capital. If you look at where mainstream impact capital is going, take a market like India, right? Huge amounts of it, the overwhelming majority of it's gone into things like financial services, so it's mostly lending, right? Technology, so asset-light stuff, fintech, edtech. And globally, these are the sectors that attract more of the mainstream, more commercial market rate money, right? Because those are the more highly scalable models, they're asset-light models. It fits more, especially if you think about equity investing, fits the sort of, profile more. Everything else, doesn't get the attention it needs. So whether you're talking about, bricks and mortar, services, the actual hospitals to deliver the healthcare that the tech enables, the actual schools to deliver the education that the ed tech enables, the actual, houses that the fintech lending will enable, support. Those are the things that are really slow to scale and slow to do, hard to do, higher risk. That's generally where we see the need for more flexible capital, more patient capital, and so that's probably how I would look at it.
So, Javi, I'm asking, just give an example of an actual thing that's on the ground today, of an example of philanthropic capital that's been applied and that has resulted in catalyzing. So, Paul gave a great example of the DIB. I'm just curious, just to give the audience a sense of what's been working on the ground, maybe an example of a transaction.
Well, or a sector, right? So the old one, MFIs, microfinance, we wrote about this 10 years ago, right? So what time we wrote about it, it's now mainstream, there've been IPOs, it's commercially mainstream, but if you go back to the early days, the early pioneers like Grameen required 16 years of subsidies philanthropically before they managed to get a break-even model. The adopters after that, when the model had been proven out, became break even much more quickly within 1 or 2 years, and then then the IPOs, SKS and so on then came on the market. So people who come in after 2007, who only see that part of the story, forget that there was an early part of the story where it was all philanthropically backed.
Great example.
So I'll give you an example of this in action at Convergence. We have a flow-through grant program called a Design Funding Facilities, and we have a range of different sleeves that we have targeting different sectors that are under-supported and underfunded. And the idea behind this program is to provide grants to innovative financial structures that we think have the propensity and the ability to go on and scale and raise additional private capital later on down the chain. And so we provide grants for proof of concept or feasibility studies. We've supported globally around 31 solutions to date. We've pushed around $8.5 million out of the door, and those solutions have gone on to mobilize and catalyze $1.6 billion of additional private financing from a range of different stakeholders. And so that is, I think, a very good example of catalytic capital right at the outset, at the early stage, when nobody is willing to fund these ideas. They're essentially ideas. And the funding that we give these organizations is to hire a consultant or to test the idea out, or do some fundraising, build a financial model. And once those are up and running, then they can go on to raise private capital. So $8.5 million going on to raise $1.6 billion.
Great example. Yuko?
Yeah, the example I want to share is a social impact bond project that we were involved in. So one city in Japan, they wanted to stop the increase of the healthcare costs that they subsidize to their citizens. So they started this anti-smoking project where they asked their citizens to join a program provided by a service provider called CureApp. And they provided this program so that the participants would have a one-on-one session online with the doctor, and then they would stop smoking after a few sessions. So this project, Social Impact Bond Project, we set 3 tranches. And the first tranche was the less risk-taking. And this was a loan by a major financial institution. And because this was a loan, they had the most less risk. And the second tranche was invested by a healthcare insurance company, a life insurance company, and also a regional local government bank. And the last tranche was invested by ourselves, CEEF, and we took the most risk by committing to a social KPI, which was further into a later stage outcome. So CEEF took the most risk as a foundation, and we had financial institutions and local bank to join this program, this Social Impact Bond Project.
It's a fascinating example of how you're actually using these instruments as almost like social change instruments, not just can I subsidize a water kiosk and so forth. And I think, Harvey, some of this is going on also with even some of the racial and equity movements. People are looking, can you speak a little bit more about that? Because I'm not sure when we think about blended finance and these kind of instruments, often I think we think about things and we think about infrastructure and so forth, but you can actually use this for social change, is that right?
Absolutely. So the funds I mentioned in, like Beacon Fund and so on, are an example of that. You're trying to break the mold of who you're giving the money to, right? Who's managing this money. So the one I think I might have spoken about before was giving money to black-led managers in the US, right? So racial equity and justice, huge issue in the US. One of the changes that is starting to bubble up is how do we change that, the pattern there, right? So 98.7% of institutional assets in the US is managed by white male asset managers, right? To say nothing of the communities and needs and businesses it's going into, right? So part of the shift has been how do we back new managers who are black-led, women-led, investing in companies that are actually going to increase economic empowerment of marginalized communities, BIPOC communities in the US. So this has been shifting over time, but again, these managers did not come in saying we want flexible capital, catalytic capital. They wanted mainstream investment capital. It's just that it's been very difficult for them to raise that from the market, especially those, especially before 2020 and Black Lives Matter and all that awareness. Even since then, it's been very difficult. And so a lot of these catalytic capital investors have been often the first investors to commit to those kinds of funds, as is true with, Beacon Fund and SWEEF in Southeast Asia. And again, I think that the commonality here is that none of these people are going to the market saying we're offering concessional returns or anything like that, right? It is in some cases just the market not being ready for these opportunities or these themes or for these new managers, and therefore that's the role that catalytic investors step into.
So, fascinating array of things that can be done. And so far, I think it's a pretty good news story. So let me sort of bring in some of my skepticism. And some of it comes from actually the examples that you've shared, right? Because ultimately, what you've described is just the really interesting role that blends can play in getting capital to happen. But philanthropic capital is the rarest of the rarest forms of capital. If you look at any of the data that was shared even earlier today by many people, you've got a little over 1 trillion assets under management, 40 billion going towards development annually, next to a market which has got 1,400 trillion under assets under management, and just 1,000x in terms of flows annually, right? So that really rare form of capital and the most flexible form needs to go to the hardest problems. And I guess this is where, the fact that it's being applied, it's only a small amount, it's being applied for blending to, get things up to, a 1.4 billion you were describing, and the fact that the capital that you guys used ended up getting USAID on board, which itself arguably should be actually a blender, right? The fact that we're using philanthropic capital to get a USAID as opposed to USAID using its capital to get hundreds of billions of dollars from mainstream financiers, that just seems like an enormous gap. And I guess if I was to ask, and anyone's free to answer this, why should we be using philanthropic, I'm convinced about the blend, but why should we be using philanthropic capital? Or perhaps when does it make sense? Because the bar needs to be pretty high. Actually, let me ask Paul first, since he's had the...
Yeah, I mean, it's a great question. You posed it on the WhatsApp group last night, and I sort of spent quite a lot of time reflecting on it. But, you know, I think, I'm not sure it does always make sense. And I think we were chatting earlier a little bit about it, but I think there's an assumption that foundations should always come in at the bottom and be the one that is the lowest in the capital stack. And I think that makes sense in some places and at some points. I don't think it always does. Like, we've had some crazy value propositions from investment arms and funds. You know, one wanted us to be the first loss to a first loss guarantee they already had from a bilateral, which made no sense to me whatsoever. You know, I think as an impact investor as well, we want to participate in similar ways. Like, we're willing to, or we can be flexible, but I guess that's the word. It's like flexibility, right? And I think, to your point, more multilaterals, more bilaterals need to flex a little bit more to truly blend, rather than assuming it's somebody else's, you know, challenge or somebody else's problem to solve. And once that's solved, then we'll come in and sort of take the returns, basically. And I think in our sector, a lot of it's about really valuing the impact that you can have. You know, I was chatting to someone earlier and saying, well, you know, actually giving someone a latrine in their home, or like a household connection of water to their property, that's got to be worth 2 or 3 basis points alone, right? So, you know, your willingness to then accept more concessional returns on that, like, if you value those two things together, if you truly value those two things together, there are many more opportunities, I think. So.
Go for it.
Yeah, so absolutely agree with Paul. You know, not everything benefits from this sort of approach, right? Just as not every problem that we're talking about at this conference benefits from a market-based approach, right? We're not trying to make this fit, you know, everything that's out there. But where there is a market-based solution, I guess that's kind of where, you know, this takes us, because then how do you get those market-based solutions to scale? You know, it's by getting more capital into those solutions, and then how do you begin that process? How do you prime the pump of that? That's what we're talking about, right? I think the other point to maybe mention is it's not all philanthropic money, right? So there's DFI money that's going into this. So we've worked with, you know, CDC, now BII, on sort of standing up their Catalytic capital portfolio, which is a new mandate from the UK government with more flexibility on the capital for them to invest. We even have examples like Prudential Financial in the US, who've set up a new, you know, not new now, but they've set up a Catalytic capital portfolio, which they see as their R&D, you know, pot of money, so they can back new mechanisms in new markets before they're proven out, and some of them then graduate into the main portfolio, you know, once they're more mature. So it's actually a wider variety of players now than before.
But Javier, are you saying the wider variety is coming in because philanthropy took the first steps? Because I guess, again, given the title of this talk, if it's a wider variety, what does it take? Why is philanthropy in there?
There's just not enough of it. I mean, you know, look at the huge array of problems and, you know, emerging solutions that we have in the world, you know. In an ideal world, I mean, the other thing about Catalytic Capital is I would hate for it to be an exclusive club, you know. It kind of happened with sort of impact investing and all of that. You know, it's like, you know, we here are the real, you know, whatever, impact investors, and you all are outside, right? And I don't think we can do that anymore. You know, in an ideal world, we'd like all investors to have more of a catalytic hat, right? And by that I mean for all investors to actually look at impact opportunities and say, what does this impact opportunity need from me and my capital to make it work? Not, these are my requirements, they're completely inflexible, how can they bend to meet my requirements, right? Ideally, we'd like all investors to be that. In reality, it's a minority of investors who will get there for now, but I'd love for more investors to get there.
I think one way in which this scarce philanthropic money can be very targeted in terms of its deployment is when it comes to building out a track record or demonstration effect. You spoke about the MFI industry. Today, most MFI businesses are commercially funded. 15 to 20 years ago, that wasn't the case. They were funded from OECD DAC budgets or from foundations and philanthropic investors that have really proved out this particular sector and proven that there's a gap between the perception of risk and the reality of risk, and that's really important to understand. So now when I look at, for example, the health or education sectors, traditionally the health and education sectors have been looked at as the domain of the public sector. Of course, you've got health tech and edu tech, but last mile delivery is still very much driven by public budgets. So I think there is a huge role to play in some of these sectors which are underfunded, or where there is a gap between the reality of risk and the perception of risk, or where the business models don't exist. A good example of that is climate adaptation. You don't have too many business models that have the underlying cash flows that can pay back these investors that we're all talking about. So climate adaptation is where, for example, philanthropic investors can play an outsized role. Another example is from a geographic perspective. If you look at the LDC versus the middle income country mix, from all the transactions that we've looked at Convergence, a majority of these transactions take place in middle income countries. India, Indonesia, Mexico. We also need to support Nepal or Sierra Leone or Bolivia. And so there is an outsized role for philanthropy to play in demonstrating that these models work in the LDC context, because again, there is a gap between the perception of risk and the reality of risk.
So this sort of role as a first mover. Actually, I'm going to come back to you on the MFI example and aligning capital versus aligning the objectives, because I think that has many sides to that story, right? But Yuko, I'm interested in I know one of the things you work with is high net worth individuals, and that's a growing area. And high net worth individuals are interesting in that you're not talking about institutions. You're talking about an individual that probably in their own heads has a whole spectrum of what is their capital, right? Whether their capital is being catalytic, whether it's just grants they're putting in here and there. So are you seeing an interesting trend there emerge where there's often an interest to say, hey, as someone who has a lot of money, I'm actually just willing to take a lot of risk and try and be catalytic in the way of crowding in additional capital? Are you seeing that happening?
Yeah, so philanthropy by high net worth individuals in Japan, I think this is a very hot area. So I think for a lot of people, non-Japanese people, Japan is like a black box because not many people speak English, and not many high net worth individuals do philanthropy. The philanthropy space is comparatively small. But recently, we started this, so I used to study in the States and work in the States a bit, and I saw a big potential of philanthropy capital doing fascinating things, like high risk-taking things. So I really wanted to do philanthropy advisory in Japan, which I started a few years ago. And I've been talking to a few high net worth individuals in Japan, and what they tell us is, well, what I found is two things. So one thing is high net worth individuals in Japan, they create their foundation in order to do better asset planning and maybe a little bit of tax benefit, to get tax benefit. In often cases, they build a foundation, but what they do is, because their motivation is asset planning, they don't really think about what they do use the foundation for, like what kind of philanthropic or social activities they do from the foundation. So they often end up doing scholarship, which is the easiest way to get the public interest certification, which is when you have this, it's really good to do tax exemption. So a lot of people do scholarship programs and get this public interest certification, but they don't really think about what kind of outcomes or impact they want to bring to their the students. So one potential I find is to leverage or utilize more foundation into doing higher quality philanthropy work. So that's one thing. And the second thing, there are a bunch of people who don't really care about tax benefit, but they're quite older and they want to think about how to spend their assets in the next 10 or 20 years. And those people say that they don't really care about tax incentive. They just want to contribute to a meaningful social project. But because philanthropy sector is like really small in Japan, and the philanthropy sector and the business sector is like it's so divided that people who, the high net worth individuals, they usually succeed in business, so they don't really know about the philanthropy sector. And there's no philanthropy advisor, so they don't have anyone to rely on in thinking about their philanthropy strategies. So this is another big potential that I see. So these people, they want to spend their money into meaningful projects, and they don't know the word or the concept of catalytic capital, but that's what they want to do exactly. That's exactly what they want to do. And we need more advisors, philanthropy advisors, and I also see potential in educating the private bankers, because the private bankers and maybe the professional services like lawyers, they're the one who's always in contact with the high net worth individuals, and they are a team. So, and a lot of private bankers tell us like their clients are interested in doing philanthropy work, but they can't have to continue the conversation because the private bankers, philanthropy is not their profession, right? So we are engaging and training the private bankers. And in a few years, what I hope to see is that private bankers acting like a semi-philanthropy advisor so that they could advise or at least connect their capital to a meaningful project, organization that's doing meaningful project.
So you're pointing to the fact that unlocking a lot of catalytic capital requires these intermediaries, right? And they're still missing in Japan, but there's a huge potential. I want to come back, Akif, to one of the points you made about MFIs. You know, one of the lovely things about capital is it's the same. It's money talking to other money. And it's really easy for money that says, well, I'll take 0% and you money over there, you take 10% because it's money talking to money, right? So blending money is like putting two pieces of water together, right? But behind that money are very different objectives. I mean, Yuko, you spoke about that really interesting anti-smoking example, right? Now, all of those people might be coming in with very different objectives. Someone might just want to sell more nicotine patches, others actually care about having less people turn up to hospitals, etc. And so in all of these blends, I understand how money gets blended. How do objectives get blended? Because that's a problem, right? Because especially if you're a philanthropy, you want to be able to walk in and say, I'm getting this leverage, but I'm still maintaining my objectives. And I think that goes back to your MFI example where, yes, when the private sector really came in, I mean, the one side of that story is the objectives went out the window. So how do we solve for that? And you know, is there some thinking around how people are trying to set up governance in such a way that the objectives are also met as part of the blend? Perhaps you can start with that.
I think, Gaurav, you gave us the mandate of being spicy or provocative. So I'll be provocative. I don't think they have to blend objectives. And that's the beauty about blended finance, where you've got various different stakeholders, commercial investors, foundations, OECD donors, impact investors somewhere in the middle, all coming into a transaction, all accepting a risk return that's acceptable to them, at the same time maintaining their own objectives and their own North Star. So the North Star for a foundation or the North Star for a development agency, of course, should be development impact. That's their mandate, that's why they're in a transaction. And they're going to be the guardian angels of impact insofar as the transaction is concerned. I would argue that a commercial investor coming into a transaction doesn't need to have that particular objective. They should be accepting a risk-adjusted return. Why do we need to care about the color of the money as long as the pie is getting bigger in that sense? And when we start asking them to think about impact or having them focus on impact, that's where they start getting confused, or that's when they start then, you know, not really participating wholeheartedly. And so my argument is, or my sort of perspective on this is, you don't have to blend objectives. In fact, keeping the sanctity of each individual stakeholder's objectives is really important in this exercise.
Well, let me push you on that, because Harvey spoke about seeding, scaling, right? So in the case of MFIs, you may seed with a particular objective, and even at that time, you could say, that's fine, I'm accepting lower returns. But if you look at the continuum of capital, big money starts to come in, pushes founders and others into a different area, or maybe founders push themselves. I'm not establishing causality. But that money comes in with different objectives. And I mean, and it did happen, right? You started to see actual change happen in the MFIs, which took away from a lot of their objectives and culture. I mean, I've spoken to folks who are like, I felt like I was working in a big social enterprise, and then private capital came in and culture changed within 6 months. So there's real world effects here. So, I mean, how do we deal with that?
So, yeah, so maybe we should disentangle the, I guess the MFI story was much more of a story about sort of sequential or horizontal progression as opposed to blending in a simultaneous transaction. So maybe just on the MFI story, I mean, it was basically the first impact sector, right, that we all sort of recognize. So it's fair to say we've all learned our lessons from the journey of the MFI story. So things like the fact that, especially in South Asia, this wasn't true of MFIs everywhere, but in South Asia, they were lending only, they didn't take deposits, so the funding base was very skewed. The governance, there were failures, there was no voice of the beneficiary, there was no, impact tracking either in the management or at the board level, very importantly, so governance was also a problem. Commercial money came in with, high expectations, so overheated, right? So it caused the under crisis and all of that. So I do think, and then there was no tracking of impact by the investors, right? So that system also wasn't there. And we're seeing all of that change, right? So impact investors now, self-avowed impact investors, even, the commercial financial institutions who are coming into this space are taking IMM a lot more seriously and having to report on these things. So complete to the early days of MFI, it's completely night and day. I mean, within a structure, a blended finance transaction, I'd agree with Akif actually. The reality is that everyone's coming into different tranches because they have different requirements. The requirements are not just about risk return. So the pattern we see is that, investors in the senior tranches will tend to take the lead on things like documentation, legals, because they tend to be the more conservative participants. Foundations coming in who might be coming into the junior tranches might be a US foundation doing it from a PRI. They've got very exacting requirements on how to justify the charitable intent of their investment, so they will take the lead on defining the impact objectives because that's their requirements and what they need to satisfy their regulators, So I do think it's horses for courses.
Sorry, Harvey, just to clarify though, in a way when you talk about seeding and scaling, right? I mean, one marker of success would be, hey, I seeded something, I didn't need to scale it, because that's very successful seeding. So we can't just talk about single instruments and tranches. So if someone has seeded and then the next, the scaling investor comes in and has completely different objectives, and we've seen this with clients have asked us this exact question of, how do I even responsibly exit, right? Because they are struggling to say, my ed tech investment, when the next person comes in to take it over at scale, it's going in a very different direction to what I originally invested for. So it cannot be that catalytic capital only works from a foundation's perspective if I have to keep following it through from seed to scale to sustain, right? So I guess what has the sector learned about maintaining those objectives? Because that blending of objectives becomes, I think, one of the big challenges.
Absolutely, yeah. So one of the things, so we've just published our C3 guidance note for seeding investors, which just came out, I think, last week. There might be a link to it on the AVPN website. We're now working on the second note, which is about scaling. And one of the points we'll want to communicate with that one is that it's not a single point in time, actually, right? So it's more of a trajectory. The problem is that the journey from something being nascent to being commercially mainstream might take 5 to 10 years, right? And so one of the things that we want from catalytic capital investors is actually a degree of, I think we're calling it stamina, you need to be able to follow things through and say, okay, we'll come in on the second fund, maybe with less risk mitigant capital than before. Maybe there's a third fund where we continue to come in but at a lower level, but can continue to influence maybe some of the impact objectives that are sort of fixed in there. I mean, I guess the other point to say is some of this stuff goes beyond the single transaction and single company, right? So part of what we've also looked at over our last decade of work is how do you create standards and public policy and regulatory frameworks. As sectors develop, in the early days, you want them to be sort of free and unencumbered, right? But actually, as they begin to scale, you want them to have guidelines and guardrails to work within. So as things scale and more money comes in, we probably need to look at, what's the regulatory framework for these companies so that they don't, go off the rails so easily.
Well, I was just going to say, I think the word stamina is a really good one. I think, I think if you're moving from seeding into scaling, keeping your investors on board and sort of keeping them on that continuum as you go through various rounds is always a good sign to another investor. And I think sometimes, you exiting, you can send a negative signal potentially. I mean, I think if I reflect on our sector, the reality of sort of capital is, particularly in sanitation or waste, is that we're starting with grant funding and we're slowly trying to get into some form of investment because our sector is probably a good 10 years behind many others in terms of the viability of it. But I think, taking that long-term view, being patient, going on that journey, but also reflecting on like what type of capital does this enterprise need now to make it a success, as opposed to I only do equity and I need a return in 5 years. You can't come into some of these sectors with these blunt tools because you'll never make investments or good investments, I would argue.
And Paul, I was going to turn to you after an audience poll, which I'm going to make a physical poll, because I want to actually all of us to reflect a little bit on, we talked about one of the pitfalls. This is there's a big governance pitfall that can happen. What are some other pitfalls and how to avoid them? Because it's complex, hard things are always hard to do, so that's fine. Like, it's still worth doing. But what are some of these pitfalls and how to avoid them? But before we do that, I wanted to get a sense of the room. Now, I know there's a polling function on the AVPN thing, but I think we can actually do this physically. So let me explain a physical poll, okay? So what I'm going to do is ask you the question of how important do you think catalytic capital is as a lever for philanthropy? So how much, if it's very important as something that philanthropy should be really looking into versus other things they do, right? Blending their money with other capital is only one thing of many things that philanthropies could be doing. So how important is it to them? Now, if it's very important, I want you to stand up, but put your hands up in the air, right? Both hands in the air. That means we think it's very important. If you just stand there like this, you think it's kind of important. And if you're seated, you don't think it's important. And if you think it's absolutely ridiculous, feel free to lie down on the floor. Okay? So let's have a look, all right? Let's see where the audience is right now. Okay. Reasonably convinced audience, guys, so I may be the only skeptic. Sorry, is someone saying something? You would have lied down, you just don't want to. Okay, so there's a hygiene issue that might have swayed things in one way or the other. My quick read of that room is I would say 50% were very high, and then another sort of 30% seemed, yeah, this is important, and then I think about 20% of you stayed seated. It's quite possible 5–10% of you wanted to lie down on the floor for good reason. Okay, so that gives you a sense of where the room is at. We might just take that poll at the end as well. Also, we will be switching to audience questions soon, and there's 2 ways you can do that. You can exercise your right to be here in person, to just get up and speak, which is definitely very preferred. But I believe the AVPN app, if you go to the live discussion for this session, we'll be able to see your questions, and I'm happy to answer them as well. So if you're a bit scared of your question, feel free to put it on here as well. So let me turn back to the panel. What are some major pitfalls in doing this work? And Paul, maybe I'll start with you because you've done a pretty, I think, an incredibly difficult transaction. So what were some of the pitfalls and how do you avoid this?
I mean, I think focusing on the why, right? I'm a big believer in focusing on why. Why are you doing this? Why this deal? Why this capital? why are you bothering? Because some of this can be really hard to do, particularly in the sector I work in. So I think you just got to be laser sharp focused. Like, I'm very clear, this enterprise needs this type of capital now, and I'm going to do this, and this is the journey I expect to happen. And then bringing in other people around that. I think that can address some of the pitfalls potentially. I think we were talking about sort of, do you need to be aligned? And I take the sort of challenge. Like, I think in some cases you do need to be really aligned. And really focused on what the impact is, but in others, I think you don't necessarily have to be. I think in the bigger fund structures, you don't really have to be, I don't think. But if you're talking at a transaction level, I think it's really important to be aligned, because I think, and to spend the time being clear what you're doing and why you're doing it. Because then I think, and that's the hardest bit, I think. And that's the bit we spent, it took us 2 years from the idea to launching the DIB. The design phase, which is the kind of negotiation, was actually quite short. But, in that 2 years, a lot of it was about alignment and being clear what we're doing and why we're doing it. And as a result, we've kind of moved into implementation. We're 2.5 years in now. We haven't had that many blips. We've had a few, but they've not been major ones. We've not had big fallings out because we're very aligned on what we're trying to do and why we're doing it.
Yeah, and that goes back to if you're clear on the intentions, then you can get people aligned on the objectives, because I still think that objective alignment is always challenging. Yuko, any big pitfalls in what you've seen?
Yeah, I don't know if I would call it a pitfall, but the difficult part is that, so when we did this social impact bond, so the low risk taker wanted to have us take more risk. Which was kind of difficult because we were taking like maximum risk. So there might be some, I wouldn't say it's a moral hazard, but the one who, if there is one organization that is taking risk, maybe the other organization would ask them to take more risk, then the risk proportion is going to be like odd. And I would say that is a very difficult part of doing catalytic capital.
Yeah, and this must come up a lot. I mean, if you're a philanthropy and your board is like, am I just cross-subsidizing some rich private equity guy by giving that away? I'm sure that, did that happen?
And the alternative is that there was a great example earlier from Tanoto Foundation about kind of how they leveraged a World Bank investment here. Now, we did something similar in Cambodia. We did a deal with the World Bank. We put, quite a lot of money on the table. We co-designed a program along with them. And the outcomes of that sort of technical assistance program in bank speak was that they launched a $55 million investment. But at the time, my board was saying to me, why, as a small UK family foundation, are we funding the World Bank? And I was saying, because the eventual leverage will be huge, right? But you just got to go on this journey with me. And they were, it took a lot of convincing. But I think that's a really good example of catalytic. Like, you're making things happen. And philanthropy can play that role. But you've got to be clear what you want to achieve by doing it, and that you can have that influence, right? The bank is not an easy partner to influence, but if you find the right people who share the same vision as you, you can do it.
I imagine that's a pretty typical tension, Akif, in what you see.
So from where I sit, I see two particular pitfalls of this particular approach. Just building off what Paul was talking about, the number one pitfall is thinking through additionality. How do we ensure that that private investment or the private investor that we're mobilizing into a transaction would not have come in otherwise? So that's number one. Additionality is important to think through. The World Bank has a cascade approach to think through additionality. The OECD has published a guidance note as part of their blended finance principles to think through additionality. It's more of a decision tree-like thinking. Because at the end of the day, we do not want to be subsidizing the private sector. That goes for philanthropy. It's even more sensitive when you're talking to OECD donors. The last thing the government of Canada wants is for this to appear in the newspaper, for example, saying, hey, look, we're subsidizing a rich private equity person, especially with the discourse that we have at the moment. Number two is thinking through what minimum concessionality is. This is particularly when it comes to fund structures. Oftentimes we see proposals saying, hey, you know what, we need 15% first loss tranche from this particular concessional capital provider. Well, how do I know it's not 10%? How do I know it's not 7.5%? And that's where good data and targeted information and case studies come in. And so additionality and minimum concessionality are really two important things to think through. And again, if any of you are interested in thinking about this in a little bit more of a technical manner, the OECD has some very good guidance notes on these two particular topics.
Nadi?
So just building on these points, I actually think, yeah, in terms of what I would call maybe strategy and focus, you know, this focus on the why, it actually links to this point about additionality, right? So one of the things that we've come across is this argument that maybe this kind of capital causes market distortions, right? And we think that's actually mitigated by doing these things that have been described, right? So if you're very clear on your intent, so the why for us maps to the way we think about it is capital gaps in the market, right? Can you describe and analyze and think about how you're targeting specific capital gaps such that what you're doing in there has a level of additionality that you can understand and justify is really key. So in terms of focus, that's really key. But a lot of the challenges that we're seeing are really in execution, right? So, and you know, ironically, the flexibility that we're calling for in the capital also leads to its own problems, right? So because people can be flexible about what kind of capital they're deploying, you know, that immediately raises the question, well, how flexible? Like how much, you know, if I'm willing to take more risk, how much more risk? Very hard to describe, right? Even within an investing organization that's deploying the capital. Imagine how much worse that is. You know, you probably all know this, you probably don't need to imagine it. It is much worse at a market level, because then when actors and participants are trying to find each other in a market without transparency about how much exactly extra risk or how much concessional pricing people are willing to deploy, it becomes incredibly difficult, cumbersome, painful, time-consuming to navigate, right? So we do need, I think, better, I don't know what the answer is, you know, platforms, knowledge, you know, directories. We need ways to find each other in that. And then even when you get into a deal situation, this dance around how we're going to negotiate terms, you know, particularly in a blended structure, is incredibly difficult. Again, because people say they're flexible. Sometimes people indicate they're more flexible than they actually are, and they don't communicate what actually their threshold requirements are until very late in the process. So, you know, deals can take a very long time to get done. So, you know, I do think we need to be working in a smarter way. So I think Arkif's point about data is really great. So one of the things we find is often overlooked is the ability for investors to share data when they're at the investor table around a particular deal. Often one or more of the investors will have more experience with that manager or that situation or that, you know, market than the other investors, but they're not sharing it, you know. And of course, there are often sort of confidentiality issues and all that, but if we can find ways to share what we do know with the others around the table, you know, that's one way to try to get more progress.
Okay, so I think that's a pretty good list. And we've got some audience questions, and I want to ask, this is the last question that I'll be asking. But this list, you know, one of the things you all talked about is additionality. Right? Even the notion of intentionality really goes to why are we additional? And that brings me to that sort of probably my biggest source of skepticism, which is around the sustaining side of things, right? And if we go back to what Harvey was talking about, that there are some problems where you might want to say, look, this thing requires a 10% blend, and it's an ongoing problem and require an ongoing blend. And I guess there the question I have is that just the easy way out? You know, philanthropic money is flexible. It's the stuff that should be applied to the hardest problems. And are we kind of saying, look, I kind of give up on this. I'm just going to give some money, and I'm going to give that money forever. And I'll give an example, right? I mean, we could say to a bank, okay, every time you lend to this group of people that you're not lending to today, I will underwrite 10% of that, right? Or take some first loss, and I'll do it forever. Or as a philanthropy, you can go out there and say, okay, who are the actors on the ground that are trying to make some systemic change and support them to either bring greater credit data, other changes that will make people bankable. And the bankable change is a sustained change versus a sustained capital, right? And so I just wonder, does the idea of a blend for sustained, with sustained capital really makes sense for philanthropic capital. I mean, isn't that what governments should be doing? Isn't that really what governments do when they fund healthcare or partially subsidize healthcare on an ongoing basis? Is there ever really a cause for philanthropy to enter the sustain part of the catalytic capital chain? Paul, you are about to speak, so
yeah, probably not forever. I think there is a role to play if you think about it as sort of viability gap financing in a sense. I think in the sanitation sector at the moment there aren't that many governments paying enterprises to deliver services on their behalf, and that's really what you're talking about. And what you can see.
But why wouldn't that be scale? Like, why would you not do that in a way that's saying, I'm scaling it up?
The role, currently a lot of governments aren't providing services to poorer households in cities across Africa and Asia. There are no models, right? But models are scaling, but there's a gap, there's a viability gap between what the customer can pay for, so revenue fees, and kind of the full cost of the service. But in the absence of the government doing anything at the moment, if that $5 per customer per month or per year is the fee that the government is paying for that service to be delivered, I think that's a viable thing from my perspective. And I think philanthropy can play a role in getting the government to the table by demonstrating, how it can achieve. But I wouldn't assume that it's going to happen for, I wouldn't sign up to something that said, in perpetuity, I'm going to provide this subsidy, essentially. But I would say, look, in the next 5 years, we're going to prove to you as the government, this is that transition. But at the end of it, you need to sign the deal with the enterprise to deliver that. And that's complicated. That's really hard because governments are transient, right? And, but I do think there is a role for sustaining, but not forever, no.
Any other defenders of sustain?
I feel the need to defend it, even though it's not actually the focus of my work. I guess my observation about philanthropy overall is, I think what we're trying to sort of encourage philanthropy to move towards, which is this idea of being catalytic, time-bound, creating a change that's sort of lasting and where you don't need to support things in perpetuity. That's sort of the ideal, right? We're aiming for that. The reality is that the vast majority of philanthropy grant funding goes towards supporting things that just need to be funded on an ongoing basis, right? So to me, I guess the question is, if you're happy to write a check to grant fund people doing rural development in Haiti, NDR, Congo, and remote parts of Indonesia, why would you not give a low-cost loan to Root Capital, which is also supporting, those farmers in those areas on an ongoing basis for possibly a very long time, So I think there's always a part of philanthropy which plays that role, which is this ongoing support. It probably doesn't map, I think maybe the discordance is it doesn't map to our common sense understanding of the word catalytic, that you can come in and do something and then you can step away, So it's very different in that sense from the first two. And what we found is actually the kinds of philanthropic players who are drawn to the sustaining conversation tend to be a different crowd from the ones who will do the seeding and scaling work.
Go ahead, Akif. Great example, though. Thanks.
Just to add a framework around that, I think it's really important to ask ourselves, well, what specifically are you solving for? And then work backwards from there. Look, blended finance is not a panacea. Shouldn't be used for every single solution. It's not a silver bullet solution. There will be several programs or issues or challenges that need traditional grant financing, and that's perfectly fine. Thank you. But, coming back to your point, right? When you have viability gap funding, you are solving for that gap between what a user is willing to pay and what the cost recovery for a particular transaction is. So then you need viability gap funding. But it is not a silver bullet solution, and I think we need to stop believing in this notion that blended finance or impact, all these great buzzwords and these terms that often people conflate. Public-private partnerships, impact investing, blended finance. It's not a silver bullet solution. And the other thing I also wanted to mention is we talk about let's mobilize the private sector, the private sector, the private sector. Who is the private sector? It's not one monolithic being. If you want to mobilize institutional investors, pension funds and insurance companies, you need a whole different approach than if you're looking to mobilize a private equity fund. A whole different approach when you're looking to mobilize an impact investor. So we also need to be nuanced and clear about what kind of private investor we're looking to mobilize.
Great. What I'm going to do is we'll do one. So I've got some questions here that the audience has sent through. But also, if you'd like to ask a question live, so why don't we start with a live question? We've got a hand up over here. Please just say your name and shoot your question.
Thanks for the great talk. My name is Yoshi Tabuchi from Zebras & Company.
Could you just speak up? And I don't know if that's the mic or, yeah. Go for it, just speak up.
Yeah, my name is Yoshi. Thanks for the panel discussion. I'm a co-founder of Zebras & Company. If you don't know about the Zebra is a concept against the unicorn that has a different growth path from the unicorn to exponential growth, which I think there's the philanthropic capital can play a very important role for these type of companies. And my question is, so basically my question is about where the philanthropic capital works. To me, there seems to be 4 types of the markets or businesses. 1, product development side. 2, market awareness side. 3, time frame. 4, the market size. And 1 and 2, I think you guys already talked about it. The product development, for example, like climate, the businesses for the climate capital, climate risk. Market awareness, maybe gender gap. It needs time to raise awareness from the market. So you need a patient capital for these 2 type of businesses. If you think about the time frame, for example, educational sector, it purely needs time. For example, education on our children in a public school, you need 10 years, 20 years to see the outcome of your investment. The market size one is more about the niche type of market or niche type of business. So it doesn't really scale, as you were talking about, the scalability, the scale of the businesses. So sorry for the long question. So my question is basically for the type of for the type 3 and 4. Do you think the philanthropic capital works for these type of businesses, or like you were just saying, is it more for the grant funding or more for a different type of capital?
And just to be clear, so 3 and 4, market awareness and niche businesses?
Sorry, the 3 is the purely, the businesses that needs time, a longer time frame.
A longer time
for the
frame.
education, for example, the education, the public sector, for example. The market size is, for example, I have seen a lot of companies in Japan. I'm from Japan. In some of the regions, and because they take care of the local residents, local people.
It's a small market size, and
exactly.
therefore
They don't want to go. They don't want to really scale into the country size.
Yeah.
Do you think the philanthropic capital works for these type of companies as well?
So I think that's a pretty interesting question, and I know that as underlying part of catalytic capital is time frame. Actually, that's part of the catalyzing ability to take more risk in a way, is that you're increasing the amount of time. But I thought I think we know the answer to that. The first one, that on the time stuff, yes, catalytic capital, what we've talked about today, has a role. But I thought the second one that was mentioned was really interesting, which is around not everything is about scaling earthing. Sometimes you need more solution providers rather than scaling solution providers rather than scaling a solution. So what about all of these like small mass enterprises around the world who are your local neighborhood services? Is there a way in which catalytic philanthropic capital can push us towards not just rewarding the unicorn approach, but also saying, if we can democratize the solution and have lots of people do that? And have you seen any examples of that? Hopefully I've tried to capture your question well. Any thoughts?
I can have a go. I mean, yes. I mean, that's clearly one of the areas that catalytic capital can step into. And maybe at this point it's worth going back to what we think of as the sort of motivation, if you like, with catalytic capital, right? Which is to start with the demand and the need and work backwards and say this is what's needed. And so one of the issues that we have, I think, in the impact investing sector is we've sort of replicated structures, approaches, models from the conventional investment area into our area without necessarily always thinking about the appropriateness, right? So one of the issues would be taking, say, a venture capital model that grew up in Silicon Valley and, you know, high growth tech startups, which is, I think, what you're alluding to there, and applying that to someone who's building schools in rural areas in, you know, South Asia, right? So that model obviously doesn't work. It's not going to have the same growth profile. So you can't actually apply a VC model to that. And so I think what you're trying to get to is, it is part of this discussion, but it's more about how do you create the right structures, you know, and the right models to be able to invest in these, right? So Beacon Fund, for instance, is going to invest in more moderate growth, women-led SMEs, right? And it describes this opportunity as, you know, too big for microfinance, too small for PE, not the growth profile for VC, right? So we actually do need more of those kinds of organizations to be stood up. I mean, India has seen a huge profusion of, like, you know, specialist lenders to SMEs, for instance, right? Vistar, and to schools, you know, so there's a range of specialist lenders, you know, so a lot of this is also debt, you know, a lot of it's not equity, which is kind of where a lot of the conversation began and where the excitement was, but actually a lot of this is debt. And maybe more flexible products. Now, that's what needs to happen at the level of product, you know, to the companies. But then behind that, then you get to this question of what kind of capital is going to go into that, right? Now, there's no reason why you couldn't have mainstream capital go into these vehicles. It's just that in our experience, the first capital into the new vehicles, because they are new and unfamiliar, is the catalytic capital. And hopefully, you know, once they've gone in and proven them out, then more mainstream capital can come in. If the returns, you know, if the profile is right and meets those requirements.
Great, thanks, Harvey. And there's a question here from Maria. Maria asks, you know, what is your advice for first-time impact fund managers trying to raise seeding catalytic capital in ASEAN? And actually, I'm going to ask Paul this question because, Paul, as a foundation, right? Often foundations seed impact investors. So, and actually, Yuko, you're similarly doing that in Japan. So for actually both of you, what would you look for when someone's coming in saying, I'm a first-time fund manager? And remember, Harvey said that part of catalytic capital is also to take bets on people, right? So what are some of the ways that what advice would you give Maria, who's looking to raise an impact fund?
So since we're a foundation that has a mandate to build the ecosystem, or we act as a field builder, we would want to, of course, increase the number of fund managers. And in the Japanese context, we don't have many impact funders, so we would happily probably invest. However, we do not do that currently. But we would love to invest in a organization that has the mind to build the entire ecosystem, not just to succeed as a fund. That would be my question.
Yeah, it's hard to say because we don't actually invest in funds. But I mean, I guess reflecting on conversations I've had with fund managers coming into our sector maybe is the way to think about it. I mean, I think being very, very clear what your kind of impact thesis is. And I think spending time developing that and sort of building consensus within your team around that, I think that then is much more helpful to potential investors coming in and looking at it and saying, right, yes, I agree with your analysis, and therefore I'm going to back you. You know, I think if you can try to be flexible with the tools that you have in your toolbox, I think, as we talked about earlier, you know, coming in and saying, I can only do equity, and I can only do it like this, and I need this, and I need that, and you know, coming up with all of these constraints will reduce the number of people that you can talk to and the funds that you can raise. And I think once you have that thesis, you know, it may be reasonably broad, but try and build up some sector knowledge or find somebody who really knows that sector, because it really frustrates me when people come into the water and sanitation sector and they have no knowledge of it at all. And it's a really hard sector, right? I'm not going to sort of hold any punches on that. It's a tough sector to work in, but if you spend the time understanding it, you can invest in it. And I'm sure that other sectors are exactly the same. But I think having some sector knowledge around that thesis will make you more credible as you raise funds.
So Maria, great advice from Yuko and Paul, and feel free to accost Akif and Harvey, I don't know where you are, but as well. We have a question on the floor there. Yeah, if you just raise your hand again, the mic will come to you in 3 seconds.
Hi, I'm Tamara Abid from BRAC in Bangladesh, and I was just wondering, alluding to what Akif said, that blended finance is not a panacea for everything that the world needs right now, and there's really a space for pure philanthropy that is needed for the world's most intractable problems, and problems with the most vulnerable and the most fragile. And what Harvey Ko said about the fact that a lot of finance and investment professionals have come into the field now, and of course a lot of family offices and investors into the development space who are looking at this, bringing in the principles and ideas from pure conventional finance and, talking about returns, measuring impact. So all of that, I understand the structure and all that is necessary to an extent, but how can we get these messages across to some of these other rooms where I've been hearing more and more conversations about how to make it more process-oriented, more structured, structured deal flow like you have in startups in Silicon Valley, starting from seed capital, angel investing, all the way, for scaling and all that. And a lot of these people haven't had any experience in the development sector. And for those of us who have had experience in the development sector and understand and look at problems differently, I think it's very important to get these messages out to those people so that there's more thoughtful ways in which we co-create solutions that are not cut and pasted from investment and finance, because we will understand a few decades down the line that this didn't really work very well. And a lot of capital and money has been wasted.
Tamara, thank you. That's a great question. I mean, I think that's talking about the fact that we are bringing a whole sector in to a place where there's a lot of people with deep knowledge. And are they still far apart from each other? And have those connections been made? Because I do keep hearing there's not enough of a pipeline everywhere. And I mean, for practitioners, and I'm sure Tamara is one of them, like, there's a big pipeline, right? So where's the disconnect, and what can be done to solve that disconnect?
I think one thing that we need to share more of in forums such as this are stories of failure. We're oftentimes writing case studies on things that succeed. We're showcasing transactions or funds that have worked and have done really well. But if you actually look at some of the stories of failure, they are exactly to what you're pointing out to, transactions or funds that are looking to solve for things where there's not really a problem in terms of trying to attract commercial capital. You don't need commercial capital for every single solution. And there are plenty of transactions, plenty of funds that I've seen that have tried to, approach every single problem with the same sort of instrument, and they've failed spectacularly. I'm not going to name some of them, but plenty of transactions, for example, that I've seen in certain parts or certain very hard to work in countries in sub-Saharan Africa, for example, have just not succeeded. Why do we need to have discussions about trying to mobilize private investors into the DRC when there's a governance issue, there's a security issue? We need to get some of those building blocks right first before we need to start talking about bringing in commercial capital to those kind of geographies. And so I think sharing stories of failure, I think, is really, really important. And being open about sharing those stories of failure, I think, are really, really important, because that's how we're going to learn. That's how we're going to grow. We're not going to grow and learn from patting each other on the back and talking about stories of success.
So just to build on that, so part of our work with C3 has been facilitating this set of learning labs, so taking experienced catalytic capital investors into a room and saying, actually, this is a safe space for us to talk about the challenges that you face and talk, and do some case studies and reflections on your experiences of where you've run into problems, how you try to solve them, share some of those, lessons, which is hard to do in an open forum, right? But it's a bit easier to do in a safe space with fellow investors. And so what was interesting about that process, and these were facilitated by a colleague, Laurie Spengler, who some of you might know. And it was just amazing watching investors open up and really, have that level of sharing and realizing that actually for many of them, this was the first time they'd ever been able to do this with fellow investors in a structured way, And so one of the things that we're going to do now, obviously with that, we're publishing the guidance notes from that, but we're also hoping to build more of a community of practice, right? So can we have a more organized network of investors who are doing this on an ongoing basis, but also sharing deal flow, right? So back to that point about that I made earlier about the it's such an opaque market, very hard to navigate. It is the case even for these asset allocators in the market because they're often looking for people who need to go into the other positions around a structure and they don't know, people don't know what they don't know and what's out there and who's looking for what, right? So actually we kind of need to solve that information problem at a market level as well to make deals happen more quickly.
That sounded like a development confessional. Sounded like a very interesting thing that you set up. We'll take one more question from the... Let me actually see how many other questions are there out there. Great. So this... Okay, there are two. So let's actually take both of them. So there's a question here, and I think... Did you have your hand up in the back, or were you stretching? You were stretching. Oh, okay. Go for it.
Can I go? Okay, actually, I wrote the same question in the app, so this is the same question. And it's pretty much similar to her question. My understanding is that mobilizing other money, bigger money, is maybe the role of Catalytic Capital, but not the purpose of it. The purpose is to bring broader social change, systemic change to the world or to specific problems that we are tackling. And to this end, I am wondering if you guys have done any other work or engagement than the providing capital or making hard work to do so. And does it make sense? I feel like we sometimes should act less like an investor, but also act as a lobbyist or educator or any other function to bring the social change. We can to lead the social change that we want to make. So if you have any good examples or any case study to share with us, that would be wonderful. And I propose to apply a Chatham House rule here, if it's possible. Thank you.
Thank you. Thank you for your question. And maybe I'll just add a little bit to it. I guess, in a way, as you are blending capital, what else can you be layering on beyond that? Because, I mean, obviously, when you're grant giving, you have a lot of ability, and maybe you shouldn't be layering much else on. That's also possible. But how else do you also act as a lobbyist? And you're not just blending your capital, but you're also saying, with this comes some advocacy and so forth. Is there ways to achieve some broader perspectives that you've seen as part of a transaction? Paul?
I think we do it in 3 different ways. So beyond finance, let's say, we provide what we call non-financial support, which is a kind of EVBA term, but essentially...
And that comes with the transaction, basically.
And it's focused on several areas: governance, which we've touched on earlier, so strengthening the governance of the enterprise. Sometimes we sit on the board of it. We provide sales and marketing support, so kind of trying to enable better sales approaches to sort of generate that growth. We look at fundraising strategies, and linked to that, we will also not actively fundraise for some of the organizations, but we will connect them into the ecosystem that we operate in. The next layer beyond that, so that's really addressing like internal barriers to that organization's ability to scale. Then we also sort of fund within the ecosystem around those enterprises, so beyond the pioneer type approaches. And we reflect on that as like external barriers to scale. So that's generally grant funding. It's generally trying to look at analysis gaps or collaboration. We try and coordinate. And then, then we, for the sector more broadly, I sit on panels like this and try and advocate that it's if you're willing to be patient and flexible, you can invest in the water and sanitation sector, and that it's much needed. The sector needs your capital. So that's kind of how we approach it, really.
We do appreciate you sitting on these panels, Paul.
Thank you.
You go.
I echo what you said, Paul. We also provide non-financial support, managerial support. Also, I think catalytic capital also is a good means to signal. For example, if a foundation is investing capital, then that kind of signals that the investee is heavily committed on impact. And I think that's one added value that an investor can provide. And the last thing is, I think, I don't know if that's what he works in the same organization as I do, but I think catalytic capital doesn't always have to be only capital, right? Like it could be like initiatives, you can take leadership. For example, one initiative in Japan is like one young entrepreneur having had this like huge disaster in Japan, like multiple huge disaster in Japan. He raised a voice and he gathered like 50 other young entrepreneurs to join this organization that supports or helps people who was affected by natural disaster in Japan. So I think that's one, because natural disaster is such a sector that you can't attract a lot of money. I think what he did was really like good leadership, and that is also catalytic act.
Okay, we're out of time, so I'm going to ask this one final question. It's a very quick one, right? Which is, if you think about where it is that this approach that we've been discussing, and it's been a really great discussion to hear about where it's challenging, but I think you guys have been very convincing around those challenges can be solved for. So, if you had to pick one area where you think there's a real need for blended capital, for philanthropies to come in, lend a bit, what is that one problem that you would love to apply this kind of approach to? Quick one-sentence answers.
I've already said this once before, but I'll mention it again. Climate adaptation.
Climate adaptation, great.
Yeah, climate or oceans and plastic.
Oceans and plastic, all right.
Community revitalization.
Community revitalization. Could you say a little bit more? Because
community, there's no one stakeholder, right? So there's no one person who would put a lot of money. But if an individual has a lot of, experience or have grown in one city, then there is huge motivation for this person to invest. And then if that person takes a high risk, then he can bring a lot of players to revitalize the community.
Great example of crowding in, okay.
Maybe building on Akif's point, I think there is a growing set of, there's an early set of solutions at the intersection of climate mitigation, adaptation, conservation, and livelihoods. So, stuff like the Forest Resilience Bond in the US, which, there's a lovely convergence case study on, start to model a set of solutions. I think we're getting to this point now where we can't, hold on mitigation or we do adaptation, or the other way around. We can't hold on, sort of social equity and justice while we do the climate things, right? So I think there's a range of solutions at the intersections that we should really be investing in and accelerating.
Great, and I'll exercise moderator's privilege and also answer this question. My dream project would actually not be about how philanthropies can be more catalytic, but how they can make other capital more catalytic. So I think there's over $1 trillion just sitting in the MDBs, the DFIs, all of these banks that are meant to actually, I think, provide some of this catalytic capital. And it is just not moving. And I think if philanthropies were able to get together and there's an advocacy push, there's some element of blending in some cases, but get that money moving, that would be huge leverage for the billions that these guys have versus the trillion that's up there. So last poll, if you thought the panel provided usefulness and some forms of mild entertainment over the last hour, please stand up. And if you thought it was pretty good, you can also put your hands up as well. And with that, please give them a round of applause. I got you guys a standing ovation, so not bad. Thank you, everybody. Thanks for listening in.
Good afternoon, everyone. Thanks so much for coming. If you can all see just for one last minute, we'll have a post-session survey that you can fill in just quickly for 2 minutes. And then just a quick announcement that the next session will be here at 4:45, so in 25 minutes. Thank you.